Hi everyone, good morning. So today we are going to start with LOS1E and LOS1E is about calculate and interpret major returns measures and describe their appropriate uses. So when we talk about the return measures and their applications, so we start with gross returns and this is very widely used and something which we use in our daily lives. So gross return is the return earned by an asset manager prior to deducting management fees and taxes, and it measures the investment manager's skill of an investment manager. And this is the return before fees and taxes. So here, fees and taxes. Pay attention to fees and taxes. This is before fees and taxes. So as of now, we have not paid to anyone, and this is our return measure. And when we talk about net return, so out of our gross return, we are actually accounting for managerial and administrative expenses. This means we are subtracting our managerial and administrative expenses out of our gross return. And net return, since we have not accounted for taxation, so this is also pre-tax nominal return for us. Pre-tax nominal return actually refers to the return before paying taxes. Why? Because dividend income, interest income, and short-term capital gains and other components, so they might be taxed at a different rate. That's why it's pre-tax nominal return. These are referred to as returns before paying taxes. And once we pay the taxes, so the returns now are adjusted for our taxation as well as managerial and administrative expenses. So those are known as after tax nominal return. So after tax nominal return after accounting for taxes and the actual return an investor actually earns and should consider the tax implications as well. So because there are going to be taxes, so if you earn pre-tax at 20% of 20% or 18% pre-tax nominal return, then you actually have to consider the implications of taxes as well. So that's why after-tax nominal return is calculated. When we talk about real return, so real return is actually the real measurement, the real measure of increase in the investor's purchasing power and how much more goods she can purchase at the end of 1 year due to an increase in the value of investment. So real return does not include inflation. So we actually have to adjust uh, our return for inflation because real return actually shows the purchasing power, increase in the purchasing power, increase in the investor's purchasing power. And this is the formula for to find the exact real return of an investment. So before we start with leverage return, let's just apply these concepts in a formula or in an example. So there is an investment manager which generates 120% $120 for every $100 and charges a 2% management fees and administrative fees. So the gross return in this case is 20%. Yes, how? So we will be calculating the holding period return. 120 minus 100 divided by 100 is going to give us 20% holding period return. And out of this 20%, we are going to subtract a 2% management fee and management and administrative fee. So we are going to get a net return of 18%. And now understand this thing. Pre-tax income and the after-tax income. So this 18% is also pre-tax nominal return. Now out of this 18%, we are going to s- calculate how much what will be our after-tax nominal return. So what we are going to do is we are going to account this 18% for our taxation income. So what we are going to do is we are going to subtract 33.33%. And this will give us a roughly a value of 12%. So this is our after-tax nominal return. But still we have not adjusted this after-tax return for our inflation component. And after this, let's assume that there is an inflation component of 10%. So 10%, how do we adjust this? for how do we adjust it for inflation component. So now this is where we apply our formula. So our nominal return. So we do not conventional calculation doesn't applies here. To calculate our real return, let's uh, discuss this formula first. So real return is nominal return adjusted for inflation. Now let's consider an investment where the nominal return is 7%, and over a year when inflation is 2%, the investor's approximate result will be we are going to subtract 5%, 2% out of 7%. So this is going to give us a rough approximation of approximation of 5%. And here also, if we apply this, so roughly it's going to give us 12 minus 10. It's going to give us 2%. Yes, right? So, but the exact return is slightly different. So exact return, the formula for exact return is 1 plus nominal rate, nominal rate is 1 plus real return, real return, and one we multiply it with 1 plus inflation. So this is going to be 1.07 is going to be 1 plus our real rate, real return, and multiply it with 1 plus inflation, which is going to be 0.02. This is going to give us our now we need to adjust, we need to calculate for 1 plus real return. So 1 plus real return is going to be 1.07 divided by 1.02. And if we calculate this thing, this whole equation, this is going to give us uh, somewhat around 4%, 4 point something. So roughly it would be 4.9%. So roughly it's going to be 4.9%. And you can see this is the exact value and this is the approximate value. 5% is the approximate value. Okay. Now, if we calculate our question here, the real return. So 1 plus nominal return. So nominal return is 12%, 1.12. When we divide it by 1 point, the inflation of 1.1. And this is going to give us in return a value of 1.818%. And this is the increase in investors' purchasing power. So that's why it's important that you pay attention to. Uh, so this is alarming. Yes, they were actually the return, the pre after tax income, the after tax return is 12%, and if you adjust it for inflation premium 10%, now the return is only 2%, approximately 2%. And yes, this is how actually the finances works. So you need to pay attention to. You need to be pay attentive. It's not alarming, and uh, this is the this is how the markets work. Okay, so that's been said. Let's talk about leverage returns. So leverage returns, most of the times, investors actually use debt component in their portfolios, and when once you use debt components in your portfolio, uh, your actually your return on the portfolio actually increases, but there is certain component which is which is which we consider. Uh, Because once you use debt, so leverage basically means debt in your portfolio. Once you use debt, there is going to be an interest component. Interest component also. So interest component is also a cost. So you need to consider, you need to account for this cost, this interest component on your portfolio. And there are two ways of creating a claim on an asset. And investors can also invest more than their own money by borrowing money. to purchase the asset. And this approach is easily done in stocks and bond, and this is very common when investing in real estates. So if half of the money is invested is borrowed, then the gross return on the investment is double. The gross return for the investor would be double. So they will be calculating they will be calculating on their money, not on the borrowed money. So the return will be calculated on the equity, not on the debt. So this is how let's discuss. Let's do an example here. So let's assume that the investor actually. So okay, let's there is an example said which says that when there is an equity portfolio of $10 million, 10 million euros, 10 million euros, and it's financed by 30% debt. So 37% is equity here, and 30%, which means 3 million, is debt. Now pay attention to this thing. They are generating a investment, they are generating a return of 8%. But there is a cost of 5%. And this 5% cost is actually on the $3 million debt out of 10%. We need to adjust this thing for our the return on the portfolio, the leverage portfolio. So we need, how do we calculate the return on the leverage return on this portfolio? So what we need to do is there is 8% return. Yes, we are generating it, but this 8% return is the overall return. But on this 3%, $3 million, $3 million out of $7 million, this is the debt component. And on this, we are generating a return of only 2% because 5%, because the 5% is actually paid as an interest on this component. So 8% plus 3 divided by 7 into 2, 3%, we are generating a 3% return on this. Once we solve this thing, this is going to give us a return of 8%. This is going to give us a return of somewhat around 9.29%. So the leverage return is 9.29, which is actually more than the return if we had all all our money invested in this thing. So we are similarly, like just like we calculate return on equity. So we actually calculate return here also. So the money which we have invested, we are going to only calculate return on that money. So we need to adjust this thing. And the leverage return of the portfolio is 9.29%, which is higher than the 8% return on the total investment. The total investment, we are considering that we are actually generating this 10% is our total return, but the leverage return is 9.29%, which is higher with the use of debt. So debt is giving us more return. I hope this is a little tricky, but this actually is important. And this leverage return component, it's the leverage return part. It will help you in your further studies. And this is introduced by CFA Institute in quantitative aptitudes in the recent times only. Previously, it was a part of portfolio and alternative investments. Now it's a part of quantitative methods. Okay, so let's start with a few question and answers. So question number one. Question number one is about, okay, the questions here are mixed, so don't get confused. So we will be testing everything which we have previously studied in the previous LOSs. And after that, we will be doing our CF Institute question and answers. So leverage after this. Okay, leverage return. I hope this is clear. So invest question number one is investor begins with 100,000 portfolio, a $100,000 portfolio. At the end of the first period, it generates 5,000 of income, which he does not reinvest. So now the investor is not reinvesting this money. And at the end of the second period, he contributes 25,000 to the portfolio. Okay. The portfolio is valued at how much? The portfolio, okay, we actually have to calculate the money weighted. Just give me a moment. Recording in progress. Okay, I hope this is fixed now. Let me just how do we calculate these kind of questions? So previously we have talked about this. So cash flow one, so cash flow zero, cash flow one, money weighted and time weighted. CF1, CF2. Here, if you can look at the question, investor begins with 100,000 they have invested initially, and the income at time one is 5,000. Yes, this is an inflow. And at the end of two, received, they have actually withdrawn. He contributes 25,000. This is actually again a cash inflow. Now at CF3, at the end of the portfolio is valued at CF3, we are assuming that they have actually withdrawn all the money. So this is a cash inflow, and the other one, this is a cash outflow, this is a cash outflow. So they have invested and they have received. This is a positive, this is a negative. So to solve these kind of questions, let's use our calculator function. So what we are going to simply do is we are going to plug in our numbers. We will go to the cash flow function. We will plug in 100,000 as a negative, 100,000 enter. Okay, this is enter. Now go second, the arrow key, CF1 is going to be 5,000. Enter. This is a inflow. Frequency is going to be 1, 25,000 minus enter. We're going to do frequency is going to be 1 because this is only once. The transaction only happened once. Now we're going to click on we have clicked enter. Now we're going to click on IRR and we are going to compute our IRR. It's going to be 0.95. 0.95 is the IRR. So this is how we compute our uh, money weighted rate of return. So 0.95 is our IRR. So 0.94, we have an option of 0.94. I hope you still remember that during money weighted rate of return and time weighted rate of return, the calculations are different. So during money weighted rate of return, we talk about IRR, and during time weighted rate of return, we talk about holding period returns and other kind of returns. During money weighted rate of return and time weighted rate of return. Or if you have missed those previous LOSs, please, I will recommend you to go to the previous readings and watch those LOSs. We have discussed about these questions, these things in detail previously. So now question number two. The question number two is here. Investor with a buy and hold strategy who makes quarterly deposits into an account should most appropriately evaluate portfolio performance using what? So here the best possible explanation here is that to use the geometric mean, because geometric mean is actually time weighted return and it's most appropriate method for performance measurement, as it does not consider additions or withdrawal from the account. So it's not sensitive to additions or withdrawal to the account. And that's why geometric mean is the correct answer or the most appropriate answer to this kind of situation. Okay, so question number three here. Question number three is saying is asking an investor buys a non-dividend paying stock for $100. It's a non-dividend paying stock, so no cash inflow during the year. Beginning of the year with a 50% initial margin. Now they have actually bought in debt here. So since when you read the first line of the question, it says initial margin, and if you talk about initial margin, you know they are talking about leverage return. And at the end of the year, the stock price is 95. Deflation of 2% occurred during the year. So deflation during the occur yeah, occurred during the year. Now nominal and real return. Now you're thinking about nominal or the real return. Which of the following return measurement for this investment would be greatest? And here we do not need any calculation. So the real return is greater than the nominal return because the inflation rate is negative. So real return is going to be higher than nominal return. Why? Because nominal return actually includes inflation. And here, if you look at this, they are not talking about inflation, they are talking about deflation. So the economy didn't went up, but it actually went down. The inflation rate doesn't go up, it went actually down. So this is -2. And since this is -2%, the real return is going to be higher than the leverage return. First thing, this is our first observation. And leverage return is more negative than the nominal return because the investment lost value and the leverage magnifies the losses here. So the best measurement here would be the real return. I hope you understood the concept here. So this is where your previous knowledge of economics is going to help you to understand the question. Unless until you have completed the syllabus one time and you actually have a holistic approach of what subjects are connecting which what subject. So don't uh, don't fill in your exam fees until you have completed the syllabus once. I would recommend you. Okay, so next question here is an asset manager's portfolio has the following annual rates of return. So asset manager's portfolio, 17 in 2017 they had 6%, in 2018 37% negative, and in 2019 they actually had the return was 27% positive. So the manager states the return for the period is So if the manager states the return for the period, so what should be he using? And simply put, if you use arithmetic return here, so arithmetic return is going to be 6% plus 27 minus 37% divided by 3. When you talk about geometric return, so geometric return, it's going to be 1 plus 0.06, 1 minus 0.37, 1 plus 0.27. I've converted those percentage numbers into uh, numbers so that we can calculate minus 1 out of everything. But before that, we need to get a cube root of this thing. Then we calculate this thing. If you calculate this thing, it's going to be minus 5.34. If you calculate it using this thing, the arithmetic mean, it's going to be 1.33%. And if you calculating using the holding period return, it's going to give you a return of 1.06 multiplied with 1 minus 0.37. You multiply it with 1 plus 0.27 and you subtract minus 1. So this is going to give you a holding period return of 15.2%. And the appropriate, the most appropriate way, the most appropriate measure to calculate these kind of returns is the geometric mean return. So you need to understand the applicability of the concepts, which we have previously discussed. So where to use arithmetic mean, where to use geometric mean, and where to use holding period returns. Okay, let's move to question number 5. So the stock is currently worth at 75%, $75. If the stock was purchased 1 year ago at $60 and the stock paid a dividend of 1.5 during the year, what is the holding period return? And if you remember the formula, the holding period return HPR is the ending value minus the beginning value, and we add the any dividends received during the period, and we divide it by the beginning value. So this is going to give us 75. We start with the 75. The currently it's 75 means this is currently the ending value. Purchased at $60, 60. We add back dividend 1.5. We divide it by the beginning value, which was $60 again. So this is going to give us a holding period return of 27.5% approximately. I'm not showing you calculator usage because I hope this much. This is actually example. This is a easy example. The calculation is easy. So wheresoever I find that the calculation might be tricky, I will share my calculator screen with you. And okay, so question number 6. So question number 6 again. Here it's stating that if the investor bought a stock for $32 and sold it 9 months later for 37.5 after receiving $2 in dividend. What is the holding period return? So holding period return again, the holding period return is the closing 37.5 minus 32 plus 2 divided by 32 because this is the beginning value. And you if you solve this, okay, so 27.5, this was our correct answer here. And if you solve this thing, so you are going to get a approximate value of 22.44 and the option is 22.44 once you solve this and convert this into percentage. Okay, so now let's go to our next question. Question number 7. Investor sold a 30-year old bond of $850 after purchased it 800 a year ago. He received $50 of interest at the time of what is the annualized holding period return. And again, they are talking about the holding period return. So the formula is he purchased it for 800. So 850 minus 800 divided by 800 plus 50. So this is going to give us a roughly estimate, rough holding period return of 12.5%. Question number 8 is Again, uh, so question number 8 is a security portfolio earns a gross return of 7% and a net return of 6.5%. The difference of 0. Okay, now here the LOS1E, which we have just discussed. So security portfolio earns a gross return of 7% and net return. So gross return is 7%, net return is 6.5%. 7 minus 6.5% is 0.5%. The difference here is due to administrative and managerial fees. Administrative and managerial fees. This is what we just discussed in our uh, this is in our LOS. So this is the only one question which we have, which is related to this LOS. And there are going to be more questions once we will start with CFA curriculum examples. Okay, so question number 9. So when we go to question number nine is are we done with this? Yes. So question number yes. Okay. So question number 9 is investor actually expects a stock currently selling for 20 $20 per share, and it's to increase to 25 at the end of the year. Dividend last year was $1, but he expects that the dividend would be 1.25% this year. $1.25 per this year. What is the expected holding period return on the stock? Okay, so expected holding period return. So previously, this information, this $1 will not be of any use to us. So they are talking about the expected holding period return. This is the this and this. So this $20, we expect that $20 would be the so right now the stock is being traded at $20. So and we expect that the ending value would be $25 along with a dividend of $1.25 and the opening or the beginning price would be $20. So this is going to be somewhat around 31.25%. So the expected holding period, now understand this thing, this is the currently, this is being sold at currently, and this is expected value. So this 25 is going to be our ending value, expected ending value. And this is our beginning value. You need to pay attention to the question. Now, this was actually a good question and it was a little tricky. So you need to apply your concepts here. Okay, I hope this is clear. So 31.25%. And this is how we have actually calculated the value of this question. So, okay, now let's talk about question number 10. So, the most appropriate measure of the increase in the purchasing power of the portfolio value over a given span of time is so the increase in purchasing power. So, purchasing power, when we talk about purchasing power, it's related to the real return. Holding period return is something which doesn't reflect the purchasing power, and after tax return is where we have accounted for taxation and other expenses related to the portfolio. So the correct answer, the most appropriate answer for question number 10 is real return. So these questions are majorly from theoretical part, and you need to understand the theory. So you need to understand theory because this is how they are actually going to test you based on your knowledge, based on your clarity of the concepts. Question number 11 here is a 10% coupon bond was purchased for $1,000. 1 year later, the bond is sold for $915 at a yield of 11%. yield is actually representing return here. Investors holding period return on the bond is closest to what? A 10% coupon bond was purchased for $1,000. 1 year later, the bond was sold for 915 at a yield of 11%. So here, the opening balance, the closing balance. Now understand this thing. Holding, they are talking about holding period yield of the bond, not the holding period return, the holding period yield. So during the beginning value is 9,000. The sold for a, this is the closing, this is the ending, and this is the beginning. If you were to calculate the holding period return, so it would have been the beginning was 1,000, the ending was 915. You subtract 1,000. 10% coupon bond means the dividend was the income from this bond was 100. 10% of 1,000, this is what they have actually received throughout this is what they have actually received. So when we divide it by 1,000, so this was supposed to give us our holding period return, but right now here they are talking about the holding period return. So here we are not going to include our $1,000 here. So this the holding period yield, the holding period yield is something which where we do not consider the beginning value. So 915, we sold it, and for out of and thousand and $100 of coupon divided by 1,000. So this is going to be given. This would be 1015 divided by 1,000. So this is going to give us a holding period yield of 10.15%. Now understand the question, they are talking about holding period yield, and this is important. So the answer to this question is okay, 10 point, my bad, 10 point, not 10 point, that's 1.015%. So this is the answer for this question, 1.5%. Pay attention to what the question is asking. If you were to calculate, now they are actually talking about bonds. So bonds, 10% coupon means this is the dividend when we talk about equity. So 10% represents the coupon rate, $1,000, 10%. And to attempt these kind of questions, you actually have to have basic understanding of bonds. You actually have to have a basic understanding of what the coupon rate means, what the holding period, what the yield means. And that's why I suggested you that before you start, before you enroll yourself for CF exam, at least complete your uh, syllabus once. Then, then make sense of how where do you stand with your preparation. Okay, so this is the last question of this reading. The bond was purchased exactly 1 year ago. Okay, just give me a moment. Yeah, we will complete this question number 12 in our next reading. So thank you for attending today's